Hello, fellow Rebel Capitalists. Hope you're well. I'm right here with my good buddy, Jason Hartman, Kenny McElroy. We're in Ken's studios. We are here for our collective mastermind group, and we figured we'd crank out a live stream because right now, hot topic, the Fed, interest rates, multifamily real estate, commercial, residential,
inflation.
Yeah, a lot to talk about here.
There's
when
nothing
it comes
going
to real
on,
estate.
George.
Well, it goes back to that Lenin quote that I always use. He said there's decades that go by when nothing happens, and there's weeks that go by when decades happen.
Yep.
And I think we're living in one of those times where decades are just happening in weeks, just in real time, right in front of our eyes.
I think you're right.
Yeah. So everyone's, I'm sure, involved in the real estate market somehow. Either they're a renter, they're a seller, maybe a potential buyer. They're trying to decide what we should do. They're trying to decide if mortgage rates are going to be higher, lower, how that's going to impact home prices. So why don't we start with Jason, and then let's move over to Kenny, because, we were talking yesterday about a personal story that you had that I would love to share with the audience, because that's not just relevant to real estate. I think it's very relevant to inflation and kind of that concept of, can prices continue to go up if we don't grow the money supply? Yep. So anyway, let's start with Jason, because I know you've really got your finger on the pulse of residential.
Is that the question? Can prices go up if we do? Is that what you're asking me?
Well, what's your 30,000-foot view of real estate, residential, where it is right now, and then what you kind of see happening in the next couple of years?
Yeah, I think that there is not going to be a giant crash like a lot of people are predicting. I do think you've got to split it up and segment it between linear and cyclical markets, that are acting very differently.
Mm-hmm.
I think the cyclical markets are going to suffer significantly, but the linear markets are going to fare reasonably well through all of this. Housing affordability is way down. The Fed has completely screwed this up. They should have raised rates much sooner and much more slowly, and we could have had a soft landing, but now they're just trying to break everything, and they're probably going to succeed.
Yeah. So, one thing that I always talk about is the difference between home prices in nominal terms and in real terms.
Yep.
And, you can have an environment where home prices only go down by, let's say, 5 or 10% over 2 years. But if you have 10% per annum inflation, now all of a sudden in real terms, you're down 20, 30%.
Right.
And, if that happens over 5 years, the next thing you know, you're right back down to that historic trend line that we had in 2012, which I think there's a better equilibrium between incomes and actual home prices. That goes all the way back to 1900.
Right.
But you can get to that point with very little decline, if any, in nominal prices. And I think that's tough for people to get their head around.
No, George, it's really good that you point that out to your audience, because that is absolutely right on the money. Nominal versus real. And you mentioned 10% inflation, but we all know the reality is the CP lie.
Yeah, right.
Not the CPI. The CP lie is telling us that, but it's really 15 to 17%. We'd probably all agree on that.
Yeah.
And the mitigating factor is that if you have a mortgage, when that happens to you, your debt corresponds, and it
Assuming
protects
that your
you.
income or your rents go up. See, that's the problem, because that inflation, it only benefits you if what you are receiving as far as cash flow goes up relative to your mortgage.
Right.
So let's just say you've got that 30-year fixed rate mortgage, inflation goes up, but yet rents don't. Then you're using that rent to pay the mortgage. Therefore, there isn't that delta that would benefit you.
Right.
So now, usually it does. Usually over
Yeah.
time, if the CPI is running at 10, you are going to have rents go up.
Yeah.
But it doesn't happen often in lockstep, especially when we're at a point which is very bizarre to me. And you guys are the real estate experts, so I'd love your feedback on, historically, have we ever been at a point, especially with residential, where home prices are at all-time highs? You've got high mortgage rates, so affordability is an all-time low, but yet rents are also at all-time highs.
Yeah.
So it's like, if you're the person that needs a roof over your head and your income's going down relative to inflation, what the hell do you do?
The bottom line is the standard of living is declining.
Yeah.
The powers that be, the elites, have created that problem, and they are literally stealing from people.
Yeah.
Inflation is a robber and a thief. It's a pickpocket. And we have asset bubbles that all this cheap money and money flowing into the system have created, and we're just going to have a decline in the standard of living. That's the bottom line. For most people, this is very bad news. For some people who know how to play their games, their cards right, who know how to play the game, who are listening to this, who get it about the way debt and inflation and assets work, they're going to benefit from it.
Yeah.
And it's just unfortunate. It's not fair. It's just the way it is.
Yeah.
And we've got to put ourselves on the right side of that equation.
Yeah. And I think from a standpoint of an investor, it's all about mindset. And so many people get hyper focused on capital appreciation because that's what's sexy. That's what's fun. My house doubled in price in the last year. But I think if you got a rock solid starter home and it's something that you never, ever want to sell, you've got to be focused on the cash flow. And if you've got that positive cash flow coming in, assuming you've got a 30-year fixed at, let's say 3 or 4%, then that's something that you most likely, depending on what your objectives are, your age and whatnot, you could hang on to, but you just got to forget about the price.
Yeah.
Because the price could go down, like we said, by who knows, 50% in real terms. But if you're still collecting that rent, then that's the reason you bought it in the first place.
True. And the other thing that's important, like I was talking about with Ken recently, is that the asset, the house, can be more valuable to you than it is to the market if you have a cheap mortgage on it, because that mortgage is not replaceable. So there's this weird dichotomy that I don't know that we've ever had before, where like that house, because it has a super cheap mortgage, could be more valuable to the owner than it is to the market.
Right.
Because the market doesn't get the cheap mortgage with the house.
Yeah.
They only get the new, more expensive mortgage with the house. And so it's a very odd dynamic that the Fed has put us into with these cheap mortgages that now have 28, 29 years left on them.
Yeah. Yeah.
So
You've got all these cross currents. Another thing I wanted to bring up is when you and Kenny were talking earlier, you're saying how with the home ownership too high, that prevents the economy from being as dynamic as it otherwise would be, because usually with an economy that's running on all 8 cylinders, people are going to go where the jobs are.
Yeah.
But if the home ownership rate is too high, then that might prevent people from going to where those jobs are, and therefore you have less economic growth. But do you think that same thing could apply to now all these people being stuck in a very low mortgage rate?
Yeah. That the low mortgage rates are super sticky, and just owning a home ownership is super sticky, right? It doesn't allow people to go to where the jobs are. And that's why I think the home ownership rate should not be 62% or 69%. It should be 50 to 55%. That's a natural home ownership rate.
Yeah, but I'm saying now it could even be worse.
Well, yeah.
Because you've got the high ownership rate.
And the mortgage that's going to keep them there.
Exactly.
So thankfully, we had COVID and some good things came out of it. And that one of them was remote work. And so that is a huge benefit for those who can do it. The
problem there now that you're seeing is the productivity.
Yeah.
Because you see this very weird dynamic where you've got very low unemployment, but you still have very close to negative real GDP growth,
right,
which would imply that we've got all these people working, but they're not doing anything.
Yeah.
Right.
Sounds like they work for the government.
Yeah. What's funny is I heard Joseph Wang talk about this, and my viewers know who Joseph is. Yeah. And he was saying that he actually admitted that even when he was working at the Fed during COVID, that he spent half the day just watching Netflix. Like he'd get out there and do a little bit of quantitative easing. And you're like, okay, back to Netflix.
I buy some bonds and then watch Netflix.
Not just bonds. I'll go ahead and buy about 10 billion.
Right, yeah.
About 10 billion for the bonds.
Yeah.
Joseph's probably the only person that you're ever going to meet that has literally bought and sold trillions of dollars worth of anything.
Right.
Yeah. It's kind of interesting to think through.
Sure is. So
Kenny, what's going on the multifamily side? And then let's go into that personal story that I think will just blow everyone's mind.
Well, a couple things. As you know, we've got right around 10,000 units, almost $2 billion in assets. And so we spend every Tuesday in our investment committee looking at a half a dozen deals that are pretty much vetted by our analysts and our acquisition guys. So we do that every week. And so the point is I'm in touch with a lot of different markets, what the brokers are doing, what the sellers are doing. Certainly when we're underwriting all of these, we're mirroring up and underwriting them with the current loans with the current loan to values, with the current expenses, all that kind of stuff. So it's pretty neat when you're that active, because not only are you looking at everyone else's deals,
Yeah.
but you're taking a look at all of those and how they compare with how you're operating.
Yeah,
And
yeah.
so it's really been an interesting time for us. And the hardest thing is that, rents are actually, they're slowing down on the rent growth, but they're still positive. So we had this
But
crazy
in your
rent growth.
markets, 'cause you're
Yeah,
in some good markets.
we are in some
I
good
mean, to be
markets.
clear, you're
Primero-
just in Arizona, Texas.
Yeah, and Oklahoma, but those markets, we've had double-digit growth, which is not healthy, but we've had that. And so when people say rents are slowing down, and it's true, but when you go from 10 to 5, it's still,
Yeah.
I mean,
But
I used to underwrite
but
2
to
or
your
3.
point, I mean, you've really got your finger on the pulse of this. And
Yeah.
I've hung out with a lot of your buddies.
Yeah,
And pretty much all your buddies are in the exact same
Yeah,
business.
we
they
are.
own
Yep.
apartment complexes,
Yes.
but some of those guys own apartment complexes in other areas.
that's
Maybe
right.
Oregon, maybe Washington, maybe
Yes,
California. So
right.
what are they seeing with rents?
Exact same stuff. It depends on where it is. If you're in, let's say, San Francisco, Portland, Seattle, New York, as an example, just to pick on those,
Mhm.
you're not seeing quite that rent growth.
Okay.
But LA, I would say. But then there's other markets like Florida, Texas, North Carolina, as an example, Arizona. We're all still doing pretty well. It has a lot to do with migration patterns.
Mm.
Where are people going? They're leaving California, as an example, and moving to Arizona, moving to Florida, wherever they're going is just putting pressure on those individual markets. So you have existing supply that can't keep up with the demand, the population of people moving there, and it's driving rents. It's everything. The restaurants are harder to get into, and housing prices are going up, and rents are going up. So all that's happening all over the place, as you know.
Yeah. What's interesting is there's never just one variable happening.
Yeah.
No, it's
Right.
always
There's always like
Yeah.
10 different or thousands really
right.
of these variables, and some of them are positive for prices, some of them are negative, and you've just got to try to understand as many of these inputs as possible
Yeah.
to try to get some probabilities of where prices may go in the future.
It's complicated,
Yeah.
which is my favorite relationship status on Facebook. So funny. It's always complicated. Is that ever not complicated?
Yeah. But people do the same thing with inflation and deflation. They get steadfast as though I'm either on the inflation camp or
Right.
the deflation camp.
It's not that simple.
And they need to realize that we have inflationary and deflationary pressures happening constantly.
At the same time.
Yeah, it's just which one
Yeah.
is kind of
Pulling more
overwhelming
than
the
the other,
other
yep.
based on those variables. And there's a lot of nuance to it.
And there's assets versus consumer prices. You can have asset inflation with consumer price deflation or vice versa.
Yep.
I mean, well, that's what we have right now, actually.
Yeah, in the
we have asset
1970s.
deflation.
Yeah.
Yeah,
And
right.
in the last few years, the other thing, George, that we're seeing is, and we never used to watch this, but who your governor is,
Mm.
that's important
Huge
now.
difference.
Yeah.
I mean,
Yeah.
you think about that. It was always important, but now it's really important
Right.
because, and also how safe, things are with the defunding. And I'm not trying to be political here, but the truth is people move for safety. They move for weather. They move for, some structure and rules. They
Mhm.
just do, and affordability. So, we're starting to see like, property taxes are really people are starting to really get jacked on property taxes because a lot of these places where people vacated, they're raising the property taxes to pay for, some of those things. So people are moving because the property taxes are going up. And so people they're sourcing, where is it that I can live that's safe, the weather's great, and it's affordable.
Yeah, right.
And that's what's happening right now. That's why Florida, even though Florida's propping up,
Yep.
but Texas is still pretty affordable. Arizona's still pretty affordable. So that's what we're seeing.
Yeah. It's funny. I did a whiteboard video the other day on just overall real estate prices. And I just went back 3 months because there's been some significant declines, even in nominal terms, in some markets over the last 3 months. But what was funny is it's pretty much every market down the West Coast and everywhere where Californians moved. So it's like, who was the guy on Charlie Brown that had the dust cloud?
Oh,
Oh,
Pigpen.
the guy with
Pigpen.
yeah, right, yeah,
Pigpen.
with a
So,
dirty blanket.
Yeah, unfortunately, the Californians are like Pigpen, and they stay there, and their prices have gone down. But everywhere they've moved, now they've brought the
and they
price
bring the bad
declines with them.
politics with
And
them.
their policy. I know.
It's so funny.
Yeah.
They escape the bad politics and then they bring it with them.
Yeah,
It's
Right.
a weird thing you can't explain.
yeah. But I also saw an interesting story that you're having a mass exodus out of Austin.
Wow.
Yeah.
So what's happening is all the Californians move there.
Uh-huh.
And then the governor says, okay, no more abortion and no
Uh-huh.
more of these. And
Oh,
they're
yeah,
like,
now we're out. Yeah, right,
or they're
yeah.
freaking out. And now they're having to move. And in this one case, the people were moving to Massachusetts
Yeah.
because
Well,
and they went away from California to Austin.
Right.
Austin got too red, or the whole state.
Yeah.
So now they're moving and they're fleeing one more time. So we'll see how that
Crazy,
turns out. But
yeah.
hey, if you could go into that story,
Yeah.
you don't have to give specific
Sure,
numbers or
sure.
anything.
Well, I'll just
But
tell
the
you.
overall concept, I
So-
think that's really powerful.
so every-
and as you're doing that, I'm going to plug in my
Sure.
laptop because it's
So-
about ready to.
So every week we're bidding on projects, and every week we're underwriting them. So we got into escrow on one deal in particular. It was a pretty expensive deal, in the hundred of millions of range. And so we had you got expenses and income. After that is your what we call your NOI, or net operating income. So imagine that. But also, George, was a really good value add. So it was like this property had a lot of potential. We'd clean up the insides, and we thought that there was somewhere between 500, 800 per unit of lift. So we were excited about this project. We put it into escrow, and the net operating income was trending really, really high. But at the debt at the time, we had about $3 million in cash flow.
Mm-hmm.
And so we're looking at that, and we're like, that is a pretty good return for what we were projecting.
But what were rates?
At the rates at
That's
the
the
time were
punchline.
in the high fours, let's say.
Right.
And then what happens was we were in due diligence. And so due diligence, as you start to walk all the units, you start to vet all the expenses, you start to look at, to prove everything out, rates started to tick up. But luckily we didn't have non-refundable money up. We had refundable money up, which is a hugely important point.
Got out. Yeah.
So, but anyway, so the rates had gone up so much that it actually impacted the debt payment by $1 million.
Right.
So we had like $1 million increase in the debt payment on the
Actually,
exact
that's
same
good.
property that we had in escrow.
Mm-hmm.
So you can imagine we went from 3 million to 2 million in net cash flow. And all of a sudden we're like, we have to walk because our return is significantly less. So the only thing that changed was the debt payment.
Right. But then the release valve there's got to be the price.
Right. So then the seller said, because we're still in escrow, we said, hey, listen, take a look at the rates. They've gone up a lot. And what could we do? And the seller's like, well, make us an offer. And we're like, no, because think about that. That was 3 federal funds rate increases ago. So if we would have, had a bridge loan, we would have still got killed. Right. So we made the decision, because I thought the Fed was going to raise rates more, and they have, that payment would have actually gone up even more, and the cash flow would have went down.
So let's think about that, though, because that's really important for the overall economy. And when we're trying to think through inflation, disinflation, deflation, because it gives us an idea of aggregate demand.
Yeah.
And those people that you're buying from, they're potential employers as well.
Correct.
So based on, let's say, the price where you went in at, let's say that's 100%. Where do you think the price would be now if they haven't sold?
So we looked at that, actually. We said, well, how would we size this? And so before we dropped it, we're like, well, maybe we still can buy it. And what should we buy it at? It was a 20% discount.
But that was 3 rate hikes ago.
Correct.
I'm saying now after
even more would be less.
Do you think it'd be 50% of the original?
I don't think it'd be 50, but it'd be a lot less. And so what's interesting is, because we're looking at, say, half a dozen deals a week, we're starting to see sellers take their stuff off the market and reprice it and come back in. So maybe we see something at 70 million, 80 million that might come in at 65 or even 50 now.
But at
based
some
on
point,
the
their
higher
investors
rate.
are going to take a loss.
That's right. And that's where this is all heading. And of course, as interest rates go up, unfortunately, cap rates go up.
Yeah.
So what that means is we can go in and do a 20% value add on the net operating income. In other words, I can raise all the rents and improve the property, but I'll lose it if the cap rate goes up, because the value is basically the same. If cap rates go from 4 to 5, and that's a 20%.
Yeah.
So what that means is that a lot of buyers are just holding back to see, where cap rate's going to go, because a lot of the managed money, the big money, let's say, Wall Street, private equity, family office, whatever, they want their money back, and they're solving to their own yield, their own IRR, and they're saying, well, We want X. Well, if the seller, or I'm sorry, the buyer, if you can't deliver X, then you're not even in the money. So the only person potentially getting anything is going to be the money that's used to buy the property. So
Yeah.
people are just holding back right now.
So,
Yeah,
so
but what
like
if prices
residential,
keep
that's a
coming down?
standoff, right? There's
It
a
is,
big-
yeah, it's seller
yeah,
denial,
right, yeah.
basically. The buyers are solving to cash flow, as they always will and always should. The sellers have been sold, like you said, they're
Yeah.
looking in the rearview mirror,
Right.
and they're saying this is what it was, and the brokers have said this is what it's worth,
Yeah.
but there's nobody bidding on.
Yeah.
at
See,
that
so much of
price.
it's psychology.
Correct.
And that's my thing that I always try to figure out is when does psychology shift? Like right now with the sellers, whether it's residential or multifamily, I would assume most of them are like, well, hang on, because the Fed's going to pivot. When the Fed pivots, they'll save my back and blah, 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 blah. But if that doesn't happen, then you get this all of a sudden one-time psychological shift where they realize that they hit the oh shoot,
Yeah.
oh shoot button, right? And say,
Not the easy button, the opposite of that, right? Yeah.
right. But seriously, but everyone comes to that realization at the same time,
Yeah.
and hits the button, and that's when you get the real.
Well, I'll tell you
price
when
decline.
reality really hits. Let's say you give me $50 million to invest in something, and you're a private equity company, and I got 3 years. You gave me 3 years.
Mm-hmm.
When that 3 years is up, you want your money back.
Mm-hmm.
You don't care. I, as the borrower of that money, have to give it back to you in 3 years. That's the big issue. The
Right.
loan maturities and when the equity wants their money back, because the money doesn't care. The money matures or it wants its money back. So it doesn't care what, somebody like me who's trying to run that building and trying to grow that net operating income. They want their capital back, period.
Right.
Because the IRR goes down,
Mm-hmm.
as you know, the longer you hold the money out. So if you give me 3 years and I'm in year 2 and I got 1 year left, I'm sweating bullets right now because I know you want your money back. Cap rates have gone up. Even though I might be performing from an NOI standpoint, interest rates are up and cap rates are up. That means that I might be out of the money. I might
Right.
just be trying to return your money back and just trying not to lose mine.
You know what else is interesting there, Kenny, as you're saying that? I'm just thinking to myself, the way dollars are created is through the issuance of debt. Most of it, through the
Yep.
commercial banks. And so if we think back and look at inflation, deflation through this lens, what I'm hearing is there's a lot less lending going on right now from the commercial banks. If there's a lot less lending, there's a lot fewer dollars that are
In the
being
system.
created.
Well, I'll tell you
So
the
if you have
first thing.
M2, which we've seen at flatline, and now we see M2 potentially go down, it makes a lot of sense as to why, because of this dynamic where there's just not that many loans being generated because the Fed is trying to slow down the economy.
There's 2 things we're seeing. The first one is they lowered the loan to values. So we used to get 70%, then it went to 60, now it's 50.
Yeah.
So our loan to value
Can't
is
get the
50.
leverage. They're
Yeah,
scared.
well, they're hedging,
Right,
right? Which is fine. And then the second thing is they're actually making us put up reserves for interest rate reserves, an actual separate bucket of money to hedge potential interest rate increases. So they're getting, you know what I mean? So, and that's a cash out refi or a new deal. So we're already seeing them tightening, through the lower loan to values.
Yeah. This is why we always say there's such a lag effect for Fed policy. Most people think that it's immediate, and it's just not. It's like our buddy Adam Taggart says, it's like the pig through the python.
Yep.
And usually what happens is the Fed continues to raise rates until they break something, but there's still 9 months or 6 months of interest rate hikes that need to filter through once they pause and once they already break something. And that's why they're usually behind the curve, and we see a big crash as a result.
Yeah, there's always this lag time, and that's why it's not instant, so they don't get instant feedback. I mean, imagine you do something today and you got to wait 9 months or a year for the feedback on it. How do you know what you're doing, right? I would argue that the market would be much faster than a central bank.
I was just going to say the bond
figuring
market.
that out.
The bond,
Yeah,
with the bond
exactly.
market.
That's why we shouldn't have a central bank, and we should have a free market that sets the price of money. But we don't.
One other story though, if you don't mind going into, is your personal story on your personal.
Oh, this is a great
because,
story.
Again, you have to give numbers, but if you just give percentages, because I think this will completely blow people's mind, and it'll give them a good idea of just what type of price inflation we have actually had.
Well,
And
be,
delays
I'll
and
be
supply
fully
chain.
transparent.
Yeah.
So I assembled some land. I'm building a personal home.
Yeah,
Right?
here in Scottsdale.
Yeah. And so I paid a couple $1 million for the land, and the home I thought was going to be around 8 million in construction.
To build for, because you're
Yeah.
just, again, you bought raw land.
Yep.
And you're planning on building
Yep.
a house from scratch.
Correct. Right.
And,
so
and you're a real estate guy.
yes.
You're not a newbie.
Correct.
You know what.
And
And he
per
does
square foot.
construction all the time.
Yeah,
and
so-
I have a construction
so-
So
company.
if anyone
Yeah.
should know
Yeah.
the cost to build
Correct.
a house, it should be you.
So I'm thinking all in $10 million, and that's, this was a home that I wanted, so I was going to build it. So anyway, so time goes by, and we're having supply chain issues, right? And so we're trying to bid this thing out. Well, the bidding came in the 16 million range
Right.
to build the house.
So double.
And
double.
so it went, the home itself went from 16 months to 28 months for construction time.
Mhm.
So the originally it was going to be 16 months, and then it went to 28 months, and the costs obviously went up almost double.
Yeah, because of labor and material.
Yeah. So I said to the builder, I said, now I'm going to be in this thing. I don't really want to own a home that's that much money, because now I'm going to be building something that's not even going to be worth that.
Right.
If you look at the market, that's the high. There's not even anything in that price point.
Right.
So I'm like, that's ridiculous. I'm not going to do that. So I had a conversation with him. He went back and said, let me see where I can cut. He cut it down to about 14 million, which is still way too high. Because remember, I started at 8. My head was around 8.
Mhm.
Now I'm still at $6 million bust. And of course, interest rates are higher.
Right.
So that's the other piece. I was 3, let's call it 3. Now I'm looking at 6 or 7. So that's the other piece. So I went back to the builder and I said, listen, I don't know. I'm not going to build this right now. I'm going to put this on pause. I still own the land, free and clear, of course. And I'm just going to wait. And I said, if I wait a year, maybe we can go back to that 60th month time frame, and my moving date might still be the same.
Yeah. Yeah.
But your price will be
From
lower.
28,
Yeah.
from 28 down to 16. Now, that's, by the way, I'm looking at every line item here.
Yeah.
I'm digging in hard, and things are just significantly more expensive. The supply chain, the labor, all that stuff. The bids are just crazy right now.
Yeah. It's not like the increase in price was just profit.
No.
That's the
Yeah.
point I really want to make
Yeah.
to the viewers here, guys. You got to understand that they're pretty much passing on their costs to Kenny, to the customer. And so I think you had a conversation with them saying, well, are most people backing out of the deals right now?
And he said yes.
And they said, yes, absolutely, for the same reason. But you got to think that through. At a certain point, they can only lower their prices so much. It is what it is.
Then they just stop building and there's a shortage.
Right. Well,
That's what happens.
but then what happens to the employees?
Yeah. Well,
See,
it's
then
a-
the
it's a
workers
cycle.
will that's
Yeah,
what I'm
it's a
talking about.
vicious
You
circle,
got it.
yeah.
We're just talking about one little story here, one little
Right.
anecdotal story. But if you
Well, think of all the big
extrapolate
home
this-
builders and the tech
but
companies, right? And,
extrapolate
yeah,
it through the entire
Right.
economy.
Yeah.
That's true.
Sure.
That you have all of these deals that would have happened,
Yeah.
but now with the higher interest rates and the higher inflation, that was a result
Yeah.
of the central planners shutting down the economy to begin with and doing all the stimulus, like all the quote unquote free money.
Yep.
Now we're having to pay the price for all that quote unquote free money. And so it just happens there. Then the builders have no deals in the pipeline
Correct.
and they can't lower their prices. So they just basically go out of business. They have to fire all of their employees who now lose their job. You see the unemployment rate go up.
Yep.
And this is this lag effect that we're talking
Right.
about from the Fed continuing to increase interest rates and increasing interest rates faster than they have in, call it 40 years, 40 plus
I'll
years.
tell you one other quick
Yeah.
story. So there's something that's called the GMP. That's called the gross maximum price. So as a developer, you try to get all your costs buttoned down, and then you bring it to the bank and you say, these are my costs, and they verify them with the general and the subs.
Mhm.
Then you break ground. All of a sudden, the framing cost is higher, the concrete cost is
Yeah.
higher,
Right.
the wire. So that subcontractor come back to you and they say, I can't deliver this. And, so what I mean is that your GMPs are not enforceable because the contractor's going to walk. Why would I finish this project at a loss for you when all my costs went up?
Right.
Just like price controls when the
So
government tries
that's
to
going
do it.
on
Same
right
idea.
now. And
Yeah.
this is important, George, because for us, we had to once you put the deal together, the equity plus the debt, and you start, on one project, we're $7.5 million a bust.
Hmm.
that 7.5 million has to come from something. It's not coming from the debt.
Right.
It's coming from the equity. So if you don't have that equity to finish that project, which Ross and I put in, it's not being finished. You have to squeeze down the investors,
And there's
bring
no
in
cash
new
flow
money.
for the debt.
Correct. Right. Well, the debt is the debt, right? The
Yeah.
lender's like, well,
But I'm saying if you don't finish the project, then there's no cash flow to service the
that's
debt.
right. So this is what's happening right now. So people with money, they have to be, subsidizing these budget busts. And by the way, we were only 12%. And everybody that I've talked to said, that's pretty good. 12% is pretty good. And it's a $50 million construction project. And so this is what's happening kind of behind the scenes. If you don't have the liquidity to be able to subsidize, once that deal starts, it's game on, right? You have the equity and you have the debt. If you bust that, and these GMPs are not holding up because the contractors, they're saying, listen, all these things have gone up on me. From the time I told you it was X, it's now X plus, and we can't deliver.
Yeah.
So
what I'd like you guys to talk about, because both of you guys have been in the real estate game for so long, I'd like to go back to the GFC and think through 2009, 2010, when interest rates went down to zero. Because it's a misconception that I see so often where people think that if interest rates are low, then that means there's all this free money and money's loose, and the money expansion is just going to grow, and M2 is going to skyrocket because the Fed's artificially lowering interest rates. But often that's not the case. In fact, it's the opposite, where low interest rates, and Milton Friedman pointed this out, that low interest rates often mean tight money, not loose money. And sometimes high interest rates actually mean loose money. So in your experience with the residential side, how was money in 2009-10 when interest rates were at zero? And then same question for you on the multifamily.
So that's a good point. So, it's the price of money, right? If there's not a high price on it, there's going to be less of it, right? Because fewer people want to supply it, right? Although our system is much more convoluted than that, obviously. But what happened during the Great Recession is a little bit different, and it makes it hard to slice that argument up because of all the toxic debt out there. That was a big part of that equation. So I remember when you could get virtually unlimited loans to buy rental properties. And then they cut it down to 2 loans. You can only have 2 financed properties during the down the worst part of the Great Recession, right? Maybe 2008. That was more like 2008, 2009. Okay. And then they expanded it, and we were jumping for joy at my company. You could have 4 financed properties, right? Now you can have 10. And if you're married and your spouse can qualify, you can have 10 more.
Right.
Fannie Mae, Freddie Mac, those are called agency loans, right? And then you can
this
do
proves
other
the point. You're saying now, as in right now, when interest rates, the Fed funds is at 3%. So now you can do 20 homes when interest rates are 3%, but when interest rates were 0%, you could only do 2.
Well, you could do the 10 back about 10 years ago.
But you see what I'm saying? When they dropped rates down to 0, you could only do 2.
Right.
And now when interest rates are much, much higher, you can do 20.
The thing people need to get their head around is mortgage credit availability. Not just interest rate. And so I'd encourage you to just go online and search. Don't Google it because they're evil, but just search it, DuckDuckGo it. The Mortgage Credit Availability Index, the MCAI, published by the Mortgage Bankers Association. And that's a really good thing because it doesn't talk about interest rates. It talks about availability of credit in the aggregate, right? And that's a really important thing to understand. So credit is available. Not as good as it used to be, but now the cost of the credit is higher. So maybe more will become available, which is the counterintuitive thing that you're pointing out. Yeah.
So what was your experience during the GFC as far as money being cheap, but yet tight? Was it loose for you because you had so many banking relationships?
So there were a few things happening during that period of time specifically. First of all, there were no investors. That's really important.
You're talking about 2009-10, right?
Yeah, I'm saying, the $100,000, $250,000 investors were on the sidelines. They were hemorrhaging in other areas, and they were scared, and they were holding back. So what we did is we went to Canada because the Canadian,
they didn't have the crisis.
Canadian dollar was strong against the U.S. dollar,
right?
And it looked like the U.S. was on sale. So that's what we did, initially to go get capital to buy real estate. On the real estate side, what was happening is the real estate was defaulting back to the banks.
Mm-hmm.
So a lot of banks owned commercial property during that time. So we were negotiating with the banks. And so what we were negotiating against was, once we took that toxic real estate from you, what would it be worth when we fixed it?
Mm-hmm.
So that's what we solved too. We had one deal that just people just can't believe, but it's true. We had a bank approach us and said, we're going to give you 200 units. Give you 200 units in Arlington, Texas. But you have to take on the loan, and we're going to give you $2 million to fix it.
Mm.
So after calculating the loan plus the cost that they were going to give me, by the way, it was basically 100%. They wanted it off their books. But after all of that, we passed because the property is still less, because they didn't want to take a write down on their debt. So what was happening is when you could negotiate a write down, if a bank's holding a $20 million toxic loan, defaulted loan on their books, and I'm trying to buy it at 15, that means they have a $5,000 issue or $5 million write down on their, against.
Right.
So all that was going on, and so the banks were holding tight. So we ended up doing a lot of deals by buying toxic debt, having the banks write them down, and of course you can't finance them because
that's my point with money being tight.
Yeah.
Other than the bank that owns the asset, they'll say, "Hey, we'll give it to you, but we'll give you $2 million in debt to take it off our hands." But that's the only type of financing where still, although there may be some that's available to you, it's a heck of a lot less than we have in today's environment where interest rates are much higher.
And the rates were in 6.5 at the time, but the banks had to self-finance those. Because like one we bought from Bank of America as an example, you're not going to go out and get a loan.
So they couldn't flip the paper.
No.
So therefore the interest rate's going to be higher because they need a higher risk premium.
Right.
Yeah.
Yep. So
what Kenny just described is literally the world's most motivated seller.
Yeah.
And he still didn't take the deal.
Yeah.
I know. It's crazy to think about going back and looking at, but when we stabilized the property, we felt that it wasn't going to be worth what we're into it for.
I'm curious, were you right? In hindsight,
we were, I mean, now, 10 years later, it looks better, but at the time, 100%, we made the right decision.
Yeah.
You know what I always say in the world of real estate investing, every deal looks great in the rear view mirror. I mean, there's probably some outlier exception out there, but it's a saying. You just got to go far enough away,
it all looks
to get that rear view mirror in a wide enough angle, then it looks good. Yeah.
So what on earth would you do right now if you were a homeowner? We'll go through, and I know you can't paint it with that broad of a brush, but let's go through some specific examples and say, okay, if you're this guy or gal, what would you personally do?
Yeah.
So let's start off with, an easy one. If you were a guy or a gal in a cyclical market, and you had a house, let's say you bought it 4 or 5 years ago, what would you be doing? What would your thought process be right now?
I would be thinking, if it's a cyclical market, contrasting to a linear market, which is a market where I'd be holding. A cyclical market, I would consider selling. Depends on life situation, depends on a million things.
Let's just say if it's just a strictly financial decision.
I would consider unloading that property because I think that's going to go down more. And in a cyclical market, you can never make the property pencil. It's just too expensive
from a cash flow standpoint.
Yeah, if you turn it into a rental, it would never work. And a lot of these investors are kind of like fake investors out there right now because they're using Airbnb. And I want to remind everybody that Airbnb and Bitcoin, similarly, are just teenagers. They're just young kids, not proven at all. Airbnb has never been through a real recession. COVID was not a real recession. That was a weird type of recession that was pumped beyond comprehension with money. Okay. It was, the bandaged over, it was painted over with just scads of fake money. Yeah. And so, a lot of these people that think these properties pencil on an Airbnb basis, just remember, in a deep recession, the first thing that is optional that people give up is vacation.
Yeah.
And, just look at the supply of what I call non-primary beds in the world. Since Airbnb caught hold and really got popular in maybe 2012, okay, it was born in 2008, I think, or something like that. But by 2012, 10 years ago, it got really popular,
Mhm.
and it's even more so now. And all of these non-primary beds were created all around the world, and hotels kept expanding too.
Right.
The population grew a little bit, but not that much. I mean, a lot of this demand is just froth, and
Yeah.
it's going to disappear.
Yeah, but I think the
quickly.
hotels have a bit of an edge there, don't they? Because they have economies of scale.
Oh, totally. Yeah.
Yeah, and these mom and pop Airbnb owners might not.
I'm not saying never do an Airbnb. I'm just saying be more careful.
Yeah.
The past is not the future with that.
Yeah, I want to give a shout out to our good buddy Adam Taggart and his podcast Wealthy On. He just interviewed a gal maybe a week or two ago who's an expert in Airbnb on what she's saying, what she's seeing in the marketplace and the occupancy rates going from 80% down to like almost 0%.
Right.
I mean, it's there's some scary stuff out there.
Yeah.
So what do you think that could do to supply on the residential side? Do you think that
it could increase it, because the
Okay.
Airbnbs actually pencil in a cyclical market, or at least they did until very recently, right? But those are going to stop penciling out.
Yeah.
And that's more of a concern in cyclical markets, because number one, that's where most of them are concentrated, because those are hot vacation spots.
So let me
that are
just
desirable
back up
areas.
here so everyone's on the
Okay,
same
yeah.
page. So if you had a long-term rental in a
Mhm.
cyclical market,
Yeah.
and obviously there's exceptions there, but for the most part, you're going to be negative cash flow, especially if you've bought in the last couple of years.
Yeah, your deal never made sense in a cyclical
But what
market.
they do is they say, well, maybe I'll turn it into an Airbnb
Right.
because now I can rent it nightly as
Yeah.
opposed to 6-month or a 1-year term. I can increase my total amount coming in, and now all of a sudden I do have positive cash flow. But what they don't realize is they've turned themselves into a real estate asset that someone has to have, into a real estate asset that someone only wants
Very
when they have
optional.
disposable
Yeah,
income,
right.
just like a hotel.
Exactly.
Right.
Yeah.
So you're saying they're going to get caught to where their occupancy rates go down,
Or their nightly rate goes down,
or
one or the other.
right,
Yeah.
to where they can't cover their mortgage,
Right.
and now they're a forced seller,
Yeah.
which brings all that additional supply into the market. And as we were talking about earlier, the prices are set at the margin.
Yeah.
So if a few of those go on the market, that's going to bring down the value, quote unquote, for
Right.
all those other homes in the neighborhood, even if they're owner occupants.
Yeah. No, that's
And I'll just put on.
concern.
I always say Airbnb should be a plan C.
Yeah.
So in
Not
other
a
words,
plan B.
well,
Yeah.
plan A is you can move in.
Right.
Yeah.
Plan B is you could put a long-term renter in there and still cash
Yeah.
flow. Plan C is then you run it like a business, because
Right.
it is a business.
Yep.
It's not, it's active. It's not necessarily passive.
Mhm.
I mean, it's a busy business.
Yeah,
moving
you're owning
people
a
in and out.
hotel.
Correct. Yeah.
Yeah.
Absolutely.
That's interesting. So do you have anything else to add? If not, let's go over to you. because
Yeah, I just want to add what we were talking about recently, and that's the concept. This is a very weird concept. I don't think it's ever happened before, but there are really, of course, there's linear, cyclical, and hybrid markets that we always talk about, but there's also the new home market and the resale market. And I think going forward, and I'm already seeing signs of it, these are going to start to act extremely differently. Here's why. The new home market has a short fuse, and those home builders have short-term debt that they need to sell those properties. Those properties do not generate any income. They're a cost only. And the builders have ramped up production because there's been tons of demand. And now that demand is fading because of the higher rates and lower affordability. And so those builders are going to be in a position, and already are in a position, where they are really, really much more motivated to get buyers
It's
when
like
they never
it's
had
like
that
the
before.
bullwhip effect.
Yeah. And so they're going to be selling properties. They're going to be more motivated. But the resale homeowners, by contrast, because they have such cheap long-term debt with literally 28 or 29 years left on it, 25% of the mortgages in the country are at or below 3% interest.
Yeah, right.
That's insane.
Yeah.
That's never happened before. And 65% of the mortgages in the country are below 4% interest.
Right.
I mean, that makes that asset extremely valuable to the person that already owns it.
Yeah.
It doesn't matter what the market says the asset is worth as much. It matters a little bit for sure. But normally it matters a lot, right? Just people need to understand that an asset can be more valuable to the person that owns it than it is to the person who might buy it.
Yeah.
That is a very different thing.
Yeah, but see, I think you're looking at it through the lens of just an owner occupant, which is fair. But I would also look at it through the lens of that being pretty much 100% of someone's purchasing power, especially a baby boomer that just retired.
Yep.
And so that house is not only the roof over their head, but it's their nest egg.
Yep.
It's their retirement.
Right.
And I think that's where the dynamic changes. And also going back
Well,
to your point,
what does that mean though? Just share that. I'll unpack that a little bit.
because if you're an owner occupant, all you care about is a roof over your head.
Uh-huh.
You really don't care about the price.
Right.
That you locked in, you got your monthly
the
payment.
baby boomer's an investor, that retiring baby boomer, is that what you were saying?
Well, they've turned into an investor because 100% of their net worth is the equity in their house.
Are they occupying the house in your example?
Yeah.
Oh, okay.
So they're occupying the house and they've got a different motivation, let's say. So if prices go down, they're like, sure, I've got a 30-year fixed rate mortgage and I love this payment, but I've got to sell. I've got to sell, because if I don't sell now, I'm going to sell at half the price. Just in their minds, right?
Yeah.
In 2 years or something like that. And this is my retirement. This is my 401k. This is how I'm gonna, not have to work at Walmart when I'm 80 years old.
Okay. So you're saying that baby boomer retiree example, they get spooked. They have a nice low mortgage payment, but they get spooked and they want to sell it.
Yeah, because let's go back to your example with the new builders.
Because they thought they were going to live off that home equity.
Yeah, because that new builder, that's dropping their price because they can. That affects the price of the baby boomer that sees that on Zillow, let's say, right? And they see their price of their house. Let's say they're thinking right now, okay, I've got 500 grand in equity. I'm 70 years old. I'll probably live another 15 years. That 500 can get me through, even with Social Security taking a hit in real terms, because I'm not getting paid. I'm getting the COLA bump, but it's not as high as the real rate of inflation. Yeah. So if I can get 500, I'm good. But then what he sees is the prices around him going down. And it's like, you have that moment where you're like, I got to hit the bid now.
He's getting spooked.
I got to hit it now. And even if I can't go into the same house at the same mortgage payment or rent payment, I'm just going to have to go into one of Kenny's apartments and just lick my wounds, knowing that I was able to get that 500 out before that 500 turns into 250. And I'm going back to work at Walmart.
Right. And so that puts upward pressure on rents, because there's now people have moved out of the ownership market into the rental market.
Specific Kenny's rents, yes. Yeah. And that's why I think if people are exploring investing in this type of environment, I always encourage them to look at starter homes or, like B. No, I don't really like C properties.
B and C,
B and C property, like a C plus, let's say.
I agree.
Because it is true that when people's incomes go down, we have the unemployment rate, we have this dynamic we just talked about. They're going to have to live somewhere, but they might not choose to live in that A property. They can't afford it anymore, but they've got to just kind of notch it down. And that's standard of living decreasing.
There is no question that the standard of living is declining for most people, sadly.
Yeah.
And that's what people just have to look at. All of this stuff, everybody talks about, they make these sort of like glib statements. Like, if rents go way up, well, who will be able to afford to pay the rent? If prices go way up or affordability declines, whatever way you want to slice that, who will be able to afford to buy the house? Well, a different person that was at a higher socioeconomic level, they moved down the ladder.
Yeah.
And they will afford it.
Yeah.
And then that person that's in it now moves down also. It sucks. It's a terrible deal. But this is what the central planners do. They screw up everybody's life.
Yeah.
Okay. The standard of living is declining for most people, except those that know how to play the game and kind of game the system.
Yeah. And that's why that's another reason I always say that if you're going to get involved with real estate, I don't like it right now because the prices are at all-time highs. And I like to just buy things when they're cheap and sell them when they're expensive. But if you're in the game, you've got to realize that you have to have positive cash flow right now. You got to have positive, and you have to have an asset.
At how much down?
And you got to have an asset that people are going to notch down to. And to have a good,
not an expensive asset.
Exactly. That's what I'm saying.
Bread and butter.
That's what I'm saying. That's what I'm saying. Because your person that can't afford $3,000 a month right now for rent, they lose their job or whatever happens, and then they need to ratchet down to $1,500 or $2,000 a month. So you want those properties that are nice, but at the lower end there. So you most often have a person that's going to keep your occupancy rates at where they need to be to cover your
You're
debt
going to
load.
catch people moving up the socioeconomic ladder.
Yeah.
But in this era and probably the next few years, mostly moving down the socioeconomic ladder. You'll
Yep.
catch them either way. So
Yep.
the good rule of thumb for that is when you're buying in any market, buy below the median price in that market for sure. Maybe a lot below it. Okay.
Yeah.
That's a good rule of thumb. But what's interesting too is, and I just pulled up this chart, Kenny, you probably saw this one. People who buy homes, fix and flip them, have increasingly been flipping them to investors, right? To rent out, right? Long-term investors. Investors bought 22% of flipped homes last year, but they bought 44% of flipped homes in the last quarter, which is actually quite surprising that investor activity is so high still, because you're kind of saying the opposite of that, right? So it's interesting.
Investor, well, it depends. No, because I'm looking at it from a standpoint of not like a real estate guy, but like the average baby boomer.
Yeah.
That has so much of their net worth tied up in their 401k and or their home equity.
Yeah.
And they're seeing their 401k just get shellacked.
Yeah.
Especially with the bonds. I mean, the stocks are down, I don't know, 15, 20%, something like that. And we could go into even a more severe bear market going into 2023.
I'm talking about tapping equity with those baby boomers. The banks are recalling those equity lines, the HELOCs.
Yeah,
they're closing them.
Yeah.
And so if you've borrowed the money already off that HELOC, which I suggest if the rate isn't too bad, so you have the use of the cash, they can only call it in based on the terms of the loan. But if you have not used the credit line and you think you have security because, hey, I got a $200,000 credit line if I need it, that can just evaporate, and it is evaporating.
That's what
and
we're talking about,
during the
tight
Great
money.
Recession too.
Tight money.
Yeah.
That's right.
Yeah.
That's right. That's really what people need to understand is it's not just about interest rates. It's about the environment and the risk reward for the banks issuing those loans if you have to buy something that depends on credit. But okay, so I forgot to go back to some of the other examples. So we talked about someone that owns a home right now in a cyclical market. What would you say for someone that owns, what would your thought process be for someone that owns a home in a linear market, assuming they didn't have this problem that, oh my gosh, I'm 70 years old, 100% of my net worth is in my house, and I'm going to have to cash out or else risk, working at McDonald's when I'm 90 years old or something.
The linear market person who probably, 25% of you have a mortgage below 3% and 65% of you have a mortgage below 4%. And even if you have a mortgage below 4.5% or 5%, and by the way, I got that breakdown if you want it. If you're in a linear market, a good, solid, like inexpensive market that you don't hear much about on the news, keep the property. And if you have a bunch of equity in that property, first of all, I'm sorry you do, because I'd rather have you have control of that money and have the equity out of the property.
Yeah.
I always say real estate is a great investment, but it's not a great bank. Okay. I don't like having a lot of equity in the properties. But if you do, there are other options, and they may not be what you want to hear, but they are options. You can rent rooms. Okay. If you have extra bedrooms, you can rent them. You can rent the whole house out. You can dog sit. If you like animals and like dogs, right? A lot of people make quite a bit of money doing that. You can use your house for other purposes to generate income if you can't tap the equity anymore. I'm just saying those are plan B, C.
Yeah, but
I'm not saying they're ideal, like you want a roommate when you're 75. I get it.
Yeah.
But,
I think what that boils down to, though, is that if I'm someone in a linear market, I need to look at my mortgage payment, assuming that I've got a fixed rate loan. And then I also need to do some homework and figure out how much could I rent my house out for. Because if I really get into a pinch, if I lose my job, we go into a big time recession here, I need to know that I could most likely rent my house out for more than my mortgage payment so that I've got positive cash flow there. Because if you've got $1 million house in Indianapolis,
that's not going to work.
That's
if it's $1 million apartment complex, it'll work.
But so that's, I think that would be your first step, wouldn't you, is to do that math to make sure that you've got a house that if you had to rent it out, you'll have positive cash flow. And if you don't have that positive cash flow, even a linear market, you might consider selling.
And Kenny can definitely comment on this, but what I always say is that rents always lag prices by about 2 to 3 years. So when there's cheap abundant money because real estate's a credit-based asset class,
Mhm.
and it flows into the market. It pushes the prices upward. That happens very quickly. We've all seen it many times, usually. But the rents they increase much more slowly.
Right.
Okay. And think about why that happens, right? When a sale happens in a neighborhood, everybody thinks their house is better than the last one.
Yeah.
Right? Like we were talking about. And so the prices keep it with every comp, the price increases in the easy money environment. But then rents, the leases only renew once a year usually. And so
Mm.
that rent increases happen very slowly. Now, what's interesting about this is that mom and pop private landlords, which still vastly dominate the single family home rental market,
Right.
but now bigger than ever are the institutional players, the Invitation Homes, the American Homes for Rent that own tens of thousands of homes, right? And what's actually good for mom and pop investors, and I'd love to hear what you think about this, is that those institutional investors are much better at milking the yield out of their properties. They're much better at raising rents. They use software to increase the rents and optimize the rents on their portfolios. And so those rental comps actually help the mom and pop single family landlords
Mm.
because they increase the rental prices. So
Right.
just know that as the buying market deteriorates, that actually puts upward pressure on rents.
Mm.
And people might think, well, they can't afford the rent. It's not the same person. It's a different person. Everybody's going to move down
Yeah.
on the
Yeah.
socioeconomic
Assuming you've
ladder,
got one at the
right?
lower
Yeah.
end of the totem pole.
Yeah.
That's the key.
You just look at real estate's a game of staying power. Those who stay always win, right? But you've got to be able to weather the storm of the adjustment that is usually a 2-year period.
Hmm.
If you just look back, it's always like 2 years. If you get through 2 years and you don't freak out, you're going to be a winner.
Yeah.
I
But
mean,
the key there is positive cash
Kenny,
flow.
comment on this stuff.
Yeah.
You
The
got lots of
capital
thoughts about
structure
all
and
this.
positive
Sure.
cash flow.
Well, so my experience has been this: when rents, a rental market, and single family market are countercyclical. So, why rent when you can buy, right? So home builders, realtors, everyone goes after the renter to buy whatever they want them to buy.
Right.
So it's always the opposite of what people think.
Usually, but not now. I mean, now
Yeah.
prices and rents all time.
Correct. So what's happened though in the short term here is housing prices have gone up and interest rates have gone up. So the mortgage amounts have gone up
Mhm.
as it relates to rent. So if you look at the markets, mortgage cost of a mortgage has gone up significantly higher than rent
Yeah.
by a long
So
shot.
affordability is at an all-time low,
Correct.
but rents are at an all-time high.
Correct, but it's forcing people out of that mortgage market, into the single family market, into the rental market. And so that's why I believe that the rental market is going to, in the short term and the long term, is going to do very, very, very well.
I agree.
Yeah, it's not necessarily good.
Rents are still too cheap.
Yeah, if you're a landlord, it's
Yeah,
good.
I'm more hesitant
if you're,
there.
If you're a
Yeah.
resident, if you're a renter, it's not necessarily good. There's not a lot of new supply.
Yeah.
And whenever there's an imbalance from the single family ownership side over to the renter side, it just puts more pressure on rents.
Yeah.
Every single time.
But that's a derivative of income.
People
I
can
just-
buy, rent, or be homeless.
Yes.
That's the
Yeah,
choice.
but you got unemployment at 15%, and
Yep.
They're renting a lesser house. They're moving down.
They are, and so
Yeah.
you think of New York City, think of San Francisco, think of markets that are $3,000, $4,000, $5,000 a month. Renters figure it out. So we found that they just do. If they want to be somewhere, they'll sacrifice a smaller place, a roommate, or whatever it is, if they want to be there.
Mhm.
That's been my experience, at least. And what is really needed are more units, both on the home buying side and both on the multifamily side. That's what's needed. We're millions of units out of balance. This actually started over
shortage.
This actually started over 10 years ago.
Yeah.
If you really look from, let's say, 2008, there was almost no construction because the banks were taking on water. There's no one building during that long period of time. And so the new construction is relatively new in this cycle. And it has a lot to catch up from the 10 years prior to that. So, so we're severely undersupplied on the housing side. If you look at population growth, immigration, all the different things that are affecting housing, and of course every market's different, and some markets are more heavy home ownership, and some markets are more heavy renters. But
I mean, the thing that concerns me there is just in the world that you're talking about.
Yeah.
You know what happens to the homeless population?
Oh yeah,
Goes up.
Yeah. I mean, we're
Dramatically.
talking about
Well, it's already happened.
tripling, quadrupling.
Just take
Because
a
you're
look.
talking
Have
about
you been to
people.
California lately?
You're talking about people going down.
Yeah.
But that means that
Some
a
go
lot
way
of,
down to the bottom. Which
all
is
those
being
people
homeless.
are all those people that were in your properties now are homeless.
That's true.
For all those other
It's
people that
awful.
were making 100, 200 grand a year that now can only afford to be in one of your apartments. I mean, you're talking about just an explosion.
Well, look
in
at
the homeless
Seattle, look at
population.
Portland, look at San Francisco. I mean, you can just go down the coasts and see. I'm just picking on the coast because those are the higher price markets.
Right. But one of the things that Kenny didn't say, he talked about the housing shortage, and all of that is, exactly right. But what he didn't say is when you segment by price, it's even more extreme. The housing shortage, when we just talk about housing, builders haven't built entry-level homes
in
They
12
can't.
years. They
McMansions.
can't. They can't afford it.
It's not.
You can't pencil that product at all.
Land plus construction. That's the price of the house.
Show me a brand new 150, 200, even 250 home in this country. An entry level home is now $400,000.
Yeah, but that's the point. That now there is no entry level.
Correct.
Because entry level for who?
So
for a guy that's making $250,000 a year. That's the only guy that can afford the house now.
Right. So now, since no one can build an entry level home anymore, and no one can build a B class or C class apartment, workforce housing can't be built.
Right.
Everybody just moves down the ladder, and the housing shortage gets worse. Lots of builders building $600,000-$700,000 houses. Those are all over the place, and those are going to be hugely oversupplied soon.
And those are their entry.
Okay. Yeah.
That's the unfortunate thing.
Yeah. The builder, that's a good way to put it. The builder's entry level versus the buyer's entry level. That's a really good way to
big
think
delta
about it.
there.
Yeah. That's all they can do.
It's a $300,000.
They're trying. Low priced homes sell.
Mm-hmm.
But so, they're solving to the best that they can, given the land plus the construction plus the labor plus the interest rates.
So,
I think inevitably too, you're just going to have people living in less space.
Correct.
Of course.
Yeah.
Just like it's like moving. Like I did a study recently, and I put it on some slides. I said, show me $1 million house in Jacksonville, Florida. And I got this palatial, 5,000 square foot, beautiful house, marble, land, really nice lot, everything. Show me $1 million house in New York City. It was a 653 square foot condo. Mm-hmm. So the idea of that is that people will simply accept less. That's what they have to do.
Yeah.
That's just the reality.
Well,
of
you
the
see
situation.
that in South America.
Yeah.
You see that in Mexico, where I'm in
Europe,
Medellin, Colombia.
You look at
Europe,
the shitty houses they live in Europe, right?
Yeah.
Socialism's great.
Yeah. Apartments there, are just like, like I remember
boxes.
my assistant Adriana, she was living in a 50 square meter apartment.
Yeah.
In Medellin with her husband,
so that's 500
and her 3-year-old kid. Yeah, about 500 square feet with her husband and her 3-year-old kid.
Wow.
And for that's middle class.
Right. But to an American, that would be like terrible.
Yeah, but for Colombian, that's like, wow, I've got my own place.
Exactly.
Pretty good. Yeah. I recently moved her into a much bigger place, so she could just, it's kind of a perk. Yeah. But that's a good example of when people, they have to get by and they don't know any different. For them, that's like a nice sized apartment.
Expectations
and it's also interesting in Medellin when you look at the apartments, especially a lot of the newer ones. If you've got a 50 square meter apartment, 500 square feet, usually that's 2-bedroom, 2-bath.
Wow! Wow! Yeah.
And like an 80 square meter, that's like 3 bedrooms.
That's a luxurious.
Yeah. So the rooms are little teeny weeny things, and that's what unfortunately.
You think that's bad? Go check out houses in Cuba. Okay. I mean, people there live in like really small cramped spaces, but it's just all relative.
Yeah.
The expectations are going to have to adjust.
Yeah, I agree.
But the other thing, just to point out, George, if you look, there are some states, I'm going to pick on Hawaii, where Hawaii has traditionally been very expensive to live in.
Mhm.
It's because it's land constrained.
Yeah.
But there you'll see 3 generations in one household.
Yeah.
Yeah.
That's really
Multi-generational
Same in
important.
housing.
Colombia.
Yeah.
So
Same in
I think that's in the US.
You're going to see more of that.
So I think you're going to start to see more and more of that, whether
Yeah.
it's roommates or families, because that's what they do in Hawaii to be able to afford living there.
That makes sense. All right, guys. Well, we've gone an hour here. Got over
Hey.
1,000 people on the live stream. You want to?
That's great. I just want to make one more comment
Yeah.
about this housing shortage
Yeah.
and how it could be solved. The government needs to get the fuck out of the way. Okay. Like, seriously, they need to stop. I mean, it's great that all these houses are built so well and they have all these safety features, but what they're doing is they're just making people homeless.
Yeah.
Like, why can't you build a lesser house?
Yeah.
The way a house was built in the 70s, for
Yeah.
example. Why aren't you allowed to build that today?
But also, too,
They're just not
I'm
allowed.
the first person to blame the government.
Yeah.
But it's also that concept of NIMBY.
Yeah,
I
not in
think
my
they got-
backyard.
Yeah.
Yeah, right. Yeah, exactly. Yeah.
That's true.
So
But I mean, do you agree with that? Like, let them build a cheaper house.
So
you know?
I've actually gone toe to toe with a bunch of politicians on this issue. One of the things is the zoning laws, the impact
Yeah.
fees. So zoning might say you could put one house on this 1 acre.
Yeah.
Okay. Whereas before, maybe it was 2, maybe it was 4. That cost of land is very important.
Yeah.
So if you can put more on the same piece of land,
yeah,
that's a big
you got to
help.
let people build up.
Yeah, exactly. Or go higher. You're
That's
right.
what I'm talking about. Build up.
Yeah,
Yeah.
that's the other piece. So though there are, and then the impact fees are just being able to plug into the water, sewer, trash.
Yeah, you can amortize all those
Correct.
costs.
All that
over
stuff.
100 doors or
Yeah.
50 doors.
Yeah.
As opposed to
So
one.
that stuff can vary widely from county to county, city to city. And so a developer looks at those things and then says, okay, what are the rents going to be? And then passes or goes,
Mhm.
So
To bring utilities to a finished lot in a suburban neighborhood is massively expensive.
yeah.
Mm.
Versus an urban neighborhood, you've got 30 homes and you're bringing the same utilities, the same pipes, wires. I
Yep.
mean, granted, there's more because there's more people,
Yeah.
but it's just not a big deal because you don't have to run them miles and miles.
Correct.
Okay, like in a suburban neighborhood. And if people really wanted to help the environment, like the left wing supposedly does, they would allow zoning that would be more conducive to building higher density living environments.
Yeah.
that
I mean, we
it's,
got Medellin again, great example.
Yeah.
And you've been there to visit.
Yeah.
And I'll bet you 5% of the housing stock
Yeah.
is just high-rise
Oh,
apartments.
totally. Yeah.
There basically
Yeah.
are no single family
Right.
homes. Occasionally
There's
you'll
a
see
few,
one.
but,
And
yeah.
they started there
Yeah.
actually years ago. There had to have been, right? And
Yeah,
then
that started with single family.
yeah,
and
and
it
then
just
what
kept building
happens
up
is
and up
it
and up
just
and up
keeps
and up.
going up.
Right.
So that's actually what's headed. That's where we're headed.
I think I think we definitely all agree on that. So guys, thanks a lot for your time.
Yeah.
All right.
What for people want to find out more about what you do?
JasonHartman.com is my main website. And by the way, we're having an event conference coming up in
Yeah, let's talk about
Scottsdale,
that.
end of January, Empowered Investor Live. We got George, we got Ken, we've
Via
got a bunch of
satellite.
other great, via satellite. I'm trying to talk them into coming in person, but
Yeah.
anyway, and we've got a bunch of other great speakers. So join us for that, JasonHartman.com. But
And they can
my
get tickets at jasonhartman.com?
yeah,
Okay.
right there. And podcast, YouTube, you can find me in all the usual spots. Just type my name.
Okay, cool. Kenny?
Ken McElroy, KenMcElroy.com. You can find all our stuff there. We've got the collective, which we're all part of. It's our mastermind. Our next big event is at Jekyll Island.
Yeah.
How about
yeah.
The
that?
birthplace of the Federal Reserve.
In the Federal
Yeah.
Reserve conference room. So
Yeah.
if you're interested in that, go to the collectivemastermind.com. Also, we have Limitless, which is a big conference we do every June. Obviously, I go speak with these guys. So just go there. You'll find everything.
Yeah. And what's the collective website?
It's the collective
Mastermind.com.
.com. Okay. Yeah.
Or Collective Advisors. Both work.
Yeah, if you guys want more information on that and kind of for a lot of people are familiar with the mastermind group, but some people really have no idea what it is. I think it's like an investing club, which
Yeah.
it's absolutely
Kind of,
not.
Sort of is a little bit.
Kind of a little bit, but it's more like a adventure club
Yeah.
slash
lifestyle.
personal improvement, grow your business
Yeah.
type of thing.
It's great.
But you can just email Adriana, contact@georgegamma.com, and she can get you in touch with the right people. And just FYI, I just talked to Angelique today. We set up the next Rebel Capitalist Live, which is going to
good.
be in May in Orlando.
All
So
right.
Good
we'll give you the
Could be
details
good.
on that
Yeah,
soon
can't
as
wait.
well. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video.
Happy investing.
Cheers.